All right, moving on to another way that people get around. This one is going down in price. Tesla is slashing prices of its electric vehicles in the U.S. and in major European markets as the company looks to boost demand. The move comes on the heels of recent cuts in China, Japan, and South Korea as competition in the EV market grows. Yahoo Finance's Pras Subramanian joins us now with more details. And Pras, this also has to do with the Inflation Reduction Act and the various credits that people are eligible for. Couldn't look for the word eligible when we're talking about these price cuts.
Yeah, that is the big factor there. And, we had heard reports of inventory building up, new inventory building up since the first of this year because people were waiting for those price cuts. They knew they're going to happen because the way that Treasury had laid them out, it didn't really make sense. So here we are with these new price cuts. So I want to start off with a couple notable ones here. The Model 3 Performance from $62,900 to $53,900. Now, this is one of the cars that has that $55,000 price cap, right?
That's a big reduction.
That's a huge one, especially for a car that's already sort of relatively cheap as an EV. And then the Model Y, right? The Model Y Performance you see there, $69,900 to $56,900. Now, that cap is still $55K for that car, the 5-seat variant. And then now I hear the Model Y long-range all-wheel drive, $65,900 to $52,900. Now it is below that $55K cap for those tax credits. So that car, when you add that $7,500 tax credit, that goes down around $45,000, right?
I have a quick follow-up question. Yeah. These are starting prices, right?
Correct. Yeah.
So, like, if you get all-wheel drive on the 3, that's another $10,000 on top of that. Well, do the credits apply to the base price, or do they apply to the total price?
So the base Model 3 was already below. It was at $46,900. It was already below. So that went to $43,900, I believe.
Got it.
This was the all-wheel drive Performance, and that was above the $55K. Now it's below it. So now it's going to qualify it. So we're going to see people kind of come in now and probably start launching in on those orders. People cancel orders too at the end of the year because they thought this was going to happen, right? So we're going to see those orders come. We're going to see probably big delivery numbers in Q1. But the big question is, and people like Dan and I have talking about this is the right medicine at the right time. But the big question is, what happens to those margins, right? They're going to come down tremendously, and that's going to be probably a big discussion on the call on January 25th.
Okay, so this also begs the question of what happens for consumers who are now looking across some of the other options that have either made their way into the market already or are available for orders, and then they decide to take delivery elsewhere because they can offset what they're paying in the deposit by just taking delivery on some other car somewhere else.
Yeah, I mean, if you're cross-shopping Ford Mustang Mach-E, you're cross-shopping the Volkswagen ID4, the Tesla Model Y and Tesla Model 3 become infinitely more compelling at these price levels, right, compared to those. I mean, those cars will also qualify for that price, those tax credits. So it just makes the Tesla equation much more, a better equation for consumers at this point. I mean, the question is like that's pure profit that's getting cut, right? That's really bad for them.
Well, and to your point, it might be good for consumers and not great for Tesla. I mean, Tesla had that terrible year last year. This year, it's up 0.3% so far. So it's not, in other words, it has not seen a big rebound. Yeah. And we are sort of digging into what happened with the company and what's going to happen next. Yahoo Finance actually had the chance to speak to economist Paul Krugman, who's also, of course, a New York Times columnist about Tesla. He's been writing about it a lot. And he explained why he thinks it's never going to be at the same level as other tech giants from a real perspective.
Tesla is not going to be Microsoft, even if everything goes the way it should. It's not going to be Apple. This is not a network externalities, as the economics jargon, where basically people use something because everybody else is using it, and it's very hard to break out of it. And so you get decades of extremely high profits. The car industry is not like that.
So effectively saying it's overvalued, and that's why part of the reason why it's come down so much.
Well, yeah, I mean, it was the kind of industry leader, the pioneer, and it got that attractive valuation for so many years. And now it's saying, you know what, you guys are just like GM, Ford, and Volkswagen. You're making electric cars, good margin, but not astronomical valuation. So I think Paul Krugman is kind of right in that sense that it's not a software high margin company. It's going to become like a regular sort of industrial car maker. But if you're asking Elon Musk, he'll say, my software is better than anyone else's. We have the suite that we can make. We can actually add that margin back in software.
I mean, it's almost like it's a victim of his own success because the goal is for it to be a mass product. But when it's a mass product, the margins come down.
Yeah.
Because it can only be a mass product by being affordable to a large number of people.
Absolutely.
Yeah.
We're going to have much more on this. Yahoo Finance's own Pras Subramanian actually going to join us during the 11 a.m. hour as well. Be sure to tune in for the entire hour. We're going to be taking a deep dive into Tesla's stock crash and the road ahead for the EV maker. That's in our latest installment of What Just Happened, where we explain the top trending story of each week. You don't want to miss that.